Hi, this is Matthew Cratter from Trader University. And today I want to talk about how to trade IPOs like Uber. I've been getting a lot of questions. So the first thing to keep in mind with IPOs is that they can be quite volatile, they can be quite dangerous, high risk, high reward. The next thing to keep in mind is that IPOs are often a transfer, especially at the beginning, a transfer of cash from dumb money to smart money. So we can see what happened here in Lyft. We have the IPO, lots of people bail out, insiders, VCs, founders sell a lot when the stock becomes public and there's finally some liquidity, and then unfortunately stock just gets driven down. So that being said, there's still quite a bit of opportunity with IPOs, and that is for a very simple reason, which has to do with what's called the float. Now the float is just the number of shares that are actually available for trading for a stock. So you take the total shares outstanding and you subtract out all the locked up shares. So as a result, something like Lyft, they came public when they IPO'd. They issued about 33 million shares. And that was the amount of shares that were available to be traded. Now, the total number of shares was about 10x that, a little less than 10x that. It was about 273 million shares. So what this means is that you have stocks that have very few shares, the float is very small, and they're very easy to push up and to push down, which is why there's a lot of opportunity there. So the first way I like to trade them is I like to trade them as sort of a proxy for the general market. So if we look at the S&P 500, the way it traded late last year, we had a sell-off in the fourth quarter, basically a sell-off from October through the end of the year, through the end of December. Market went down. And what will happen is when the market goes down like this, new IPOs will go down even more. They will sort of trade with the market. So this is what happened to Yeti Holdings, which came public right about as the market was beginning its swoon. Came public in October of 2018. And then it sold off, and it bottomed at about the same time, end of December, that the general market was bottoming. So a great leverage way of trading the S&P is to trade one of these recent IPOs. You wait until you think you're near a bottom in the S&P, and then you buy, instead of buying the S&P 500 or the SPY, you can buy one of these IPOs, these recent IPOs like Yeti, and because they have such small floats, they will move much more than the general market. So for example, I think the S&P is up about, call it 15% year to date, bottomed at the end of 2018. You can see Yeti from the bottom, it was trading in 12 or 13, basically went all the way up to 30. So more than doubled over the period that the S&P was just rebounding, going up 15%. So that's a nice way to trade it. The next way I like to trade IPOs is to basically let them come out and see what they do. So the worst thing you can do is to jump right in. So on Lyft, for example, you think, wow, great company, I love their service, and you try to catch this falling knife. Especially when an IPO first comes out and starts going down, definitely don't want to get in the way, don't want to catch a falling knife. But what you can do, and what I like to often do, is to let them have a little trading history. So let's look at the beginning of Facebook, when Facebook IPO'd in May 2012. You can see what happened. It had a very similar chart to Uber. This was a very hyped stock. It came out here and proceeded to sell off really for the next, call it 9 months. And so what will often happen is, the people, overeager traders, will get in near the beginning of an IPO like Facebook. They'll get flushed out, and you'll have trading volume. You can see trading volume fell off quite a bit as the stock crashed. And by call it this second quarter of 2013, we were really in a trading range for Facebook. People had lost interest in it. A lot of insiders had already sold, and a lot of people who bought at the IPO just got flushed out. And so you got much less lower volatility in the stock. Volume collapsed. And then you had an earnings report where Facebook really showed that they were going to be able to turn on advertising and really monetize the platform. That happened right, let me scroll in a little bit, right here. Huge volume spike, you can see right here. You get a big gap in the stock. Stock's trading above the 50-day moving average, 50-day moving average above the 200-day moving average. All of a sudden, Facebook wakes up. And if we scroll out here, you can see what a run it had. So that's really where it started to take off. So there's no reason to be in here for the early chop. That's another way to trade IPOs. And at this point, Facebook still had a very small float. So as institutional buying came in, it was able to move up quite a bit. So keep these things in mind when you're trading, if you choose to trade Uber or just to sit on the sidelines and watch it. Please subscribe to my YouTube channel if you want to see more videos like this. Ask your questions in the comments below. Let me know what other kind of videos you'd like me to make. And if you enjoyed this video, you might want to check out my courses, Trade University. I'll put a link in the description notes below. I've got courses on swing trading with options, price action trading, and I'm actually working on a course on trading IPOs. There's a lot more to be said about this, but just wanted to get this out here today while Uber was coming public, because it's obviously a big day for that and a lot to watch. Please subscribe to my channel. Thanks a lot for listening. I'll see you in the next video.